Hi, just a video here on utilizing and understanding our three liquidity indicators and how to trade and how they integrate to give you an overall picture of what you're trading. Here I'm just looking at the ES. The reason I've got the ES open and in the 30 minutes is just so you can see why we have three different indicators. This top one here is the irregular liquidity indicator, and what it's trying to do is iron out in 30 minutes. It looks a little bit difficult to use. It's better for scalping. What it's trying to iron out is the difference between loose periods of the market and tight periods of the market. These dark lines here are the lit markets, the New York Stock Exchange hours. And if you look at the New York Stock Exchange hours in this E-minis ES S&P 500, we can see that when the market is open, liquidity is very tight. So loose liquidity here, or a liquid market, is in red. So we can see these red lines here, they are loose. And here the red parts of the market are again loose. And green is tight liquidity or illiquid. What we can see is because of the amount of trading and hedging that goes on during lit hours, when there's lots of people trading options, the market is a much tighter market. But if we go and have a look at the irregular liquidity, we can see that that isn't always necessarily the case. There's definitely some starting in the market where it starts up and it tightens up, but it then loosens up. And that's not necessarily so obvious when looking at the different indicators. This indicator here is the time series indicator. The time series indicator, if we just go down to a smaller time frame, it has 5 different lines within it, which are 5 different time periods. The fattest line is the closest time period. So here in 3 minutes, that is showing you the liquidity in the 3-minute period. So for this whole period here, the liquidity has been very tight, and that means that there are more buyers than there are sellers, and they are reaching for the ask. Here during this period, we can see that the market is generally loose, and we can see that it's been generally loose, slowly tightening, and we can see that there's not a great deal of price discovery. Other periods where we get some looseness in the market, we can see that jumping up during the lit hours here where the market is quite tight, we'll see that we get a price reduction when it's loose. And the third of these indicators here is the liquidity sentiment indicator, and it is really showing you the difference between the periods, and it's not so obvious here in the ES, but it is showing you the relative tightness of the market. So here it is showing you that it is relatively tight overnight, during the lit hours, during the New York Stock Exchange, and relatively loose during the Globex hours of Australasia and Europe. We can then go in and have a look at Australasia and Europe, and we can see the market tightening here, and we can see it loosening again. If we were looking at the price action above, we can see it starts tightening well before, because it's a leading indicator. All of the tightening of the market, the buying here, is a leading indicator. So it shows you that we're going to go into some price discovery to the north side. And then as it loosens up, we've hit here and we've had a little bit of price pullback. When trading the ES or the NQ or any of the other indexes, you would need to take into account the VIX as well, and how the VIX is, if the VIX is rising, a lot of liquidity is being soaked up in it, and whether it's this 8-cap CBOE CFD, or it's Capital.com here, which tends to have a little bit more volume during the day, not just during the lit hours. These will affect your indexes or a single stock, and you need to take the index into account, the VIX into account, and the stock into account. And you probably have to change between the different indexes, because a lot of the time the liquidity can be found, the strength of liquidity could be found in the NQ, and not necessarily in the ES minis. It could be found in a CFD over the European hours, and not in the CME lit market hours. You can see here in the CFD we get a much broader range of liquidity than we might if we just went to the ES, where we see it's really quite flat here in the ES, or even though they're looking at the same things. We do find in the time-laid liquidity that they are fairly similar. The one that I really wanted to bring up today, now we've had a quick look at the difference between loose liquidity being red and green being tight liquidity, is I just wanted to have a look at the other sort of trading, which is commodity trading. The other side of commodity trading is the pairs. So here the pairs would be gold and silver, or the metals, and or maybe Bitcoin, and the Dixie is the other side of that pair, because things are measured in the Dixie. And so when we are trading, we're probably going to be looking between the Dixie and looking at the other half of the pair, and in this case we can see that silver's held its price, and so was the Dixie, where if we go and have a look at that's silver. If we go and have a look at gold, gold's price has actually dropped back down, and that's because it's a risk off asset, and at the moment the risks have dropped with the Houthis deciding not to attack any more boats in the Red Sea, with negotiations with America after what was happening, and also that there's the tariff talks in China. And so although we saw a great price increase here, at the moment there's a little bit of a sell going on in gold, or a neutral, so it's really dropped back to a neutral level. It was affected just the same way because it is the other side of a pair, but it hasn't held its price like silver has. Now, I was just looking at these trades, and I just thought I'd show you how I would trade the different, using the three indicators. I've had a reasonably level price here. We've come to the end of the lit market here. We can see the price is rising, but it's becoming loose. That's because people are getting out of trades in this period here in the afternoon. They have been watching Fed Powell, so the market's tightened up a little bit here, and the prices dropped down as people have sold out of stocks coming into the FOMC meeting. They've wanted to listen to it, so they've stopped trading. So we get this tightening in the market, and the tightening in the market here has seen a loss in price, because the tightening in the market is actually in the Dixie. So if we quickly looked at the Dixie during the same period, we have a look at the Dixie, it was rising in this period and it was tightening, and that's going into that same period there, and that's because options have been closed, and so when they're closed, cash goes back into the Dixie. Mechanically, the Dixie tightens up. Don't get so lost in the nuance of the two. You just have to understand when you're seeing that this is really quite loose. It isn't as tight as this here. You can see here that the different time periods are running through. So the green thick line is the 3 minutes, and that is surface liquidity, where this liquidity here, these very thin lines, are up to 500 periods of 3 minutes before 3 minute periods, and so what this time layard is allowing you to do is, we can see here that this has been tightening for a long period of time. Here we can see in liquidity sentiment that it's tightened up, and during at that tightening, even though we've had one small loosening in it, really it hasn't loosened back up to this period. It's not going to drop back to that period. So if we're looking down here at the liquidity sentiment, and we've only seen a little bump like that, these bigger bumps aren't going to make us jump out of the trade straight away. We would hold the trade in that position. If we saw this jump up quite quickly like this, during a normal day trade, like here, we can see that this price, liquidity sentiment is rising quite quickly. We can probably see that the trade is over. We also see that we've had a continuation here quite quickly, and in the time layered, these thinner lines have slowly started to wash out as that liquidity has washed through. And if we're looking here again, we can see that we're going into the changeover between the Australasian Globex and the European Globex, and we can see a tightening again. So again, we might see some more price appreciation here in silver, and that would probably see silver's really a currency, probably tied to the Chinese tail. But if we look at the Dixie, we can see that there is some tightening at the moment, and it's just started to loosen. The Dixie's just started to loosen. So hopefully we might start to see some price drop here in the Dixie, and that would be seen. It's not necessarily being seen here yet. We've got very average liquidity rolling through here. It's been a little bit tighter as we'd had some price off. That's just as the afternoon's gone on. People had a longer lunch in Australia, and we've seen it pull back a little bit. But now it's dropping down into a tight layer. And if we see these drop further down into a tight layer, we will start to see some action here. So it'll be interesting to see as we go into the European if we get a really good gain in price again in silver as the Dixie pulls back, which would suggest that market makers are buying back the volatility trades and the 1 month puts that volatility is measured in the S&P 500 and in the similar indexes, the SPY and things like that. So they're buying the puts back, and as they buy the puts back, they're buying their hedge back in the market, and that is tightening the market again and loosing the Dixie. So hopefully we'll see some price action in that. Anyway, I hope that wasn't too long a video explaining you the uses of the three different indicators. I hope you enjoy using our three different liquidity indicators. Thank you very much.